So banks are the backbone of any economy, right? We're not going to dispute that. Even the Fed is a bank, which most of us know as the bank that actually creates money. But what if I told you that all banks have the right to print their own money? Technically, you can open your own bank and start creating your own money. Luckily for us though, there's a much easier way to make that buck. Like, why go through that whole hassle when you can simply start your own cryptocurrency and maybe become a billionaire overnight? That's what quite a few people have been doing lately. And here's the thing. If cryptocurrency seems like a scam to you, then chances are you don't really know too much about the banking system. And that's the point of this video, to talk about 5 facts that banks don't want you to know. Because if everyone knew this, the banking system as we know it today could very well collapse. Just like Henry Ford once said, it's well enough that people of our nation do not understand our banking and monetary system. For if they did, I believe there would be a revolution before tomorrow morning. Now that is a powerful statement that unfortunately most of us don't even think about looking into. So let's go ahead and get started to see what banks don't want us to understand and how it could benefit you. So the first thing that banks don't want you to know is that keeping money in your bank is a scam. And let me ask you a question here real quickly. How much interest would you expect to earn if you deposited your savings? At first, you might expect that it would be a few percent, right? But if you actually look at the numbers, you'll find that it is a lot less than that. Now, just so you know, the top banks offer less than 0.5%. There are banks that offer higher rates than that, but they're still less than 1%, especially since interest rates are really low right now. I want you to think about this for a second. Your money grows by 0.5%, while inflation increases by 2.5%. This means the intrinsic value of your money is decreasing every single year. So what does that mean? It means you're much better off spending that money today rather than keeping it in the bank. The purchasing power of your money in a few years is going to be much less than it is right now. And with inflation constantly increasing or skyrocketing like it is, assets are of course increasing in price. Like homes, stocks are rising exponentially like we've been seeing in the past year or so. So the bottom line is, a bank is a place to just store or park your money. It's not a place to move and make money. Alright, the next thing that banks don't want us to know is that every bank has the right to create money out of thin air. Now I know this is something that's hard to believe because the only bank that's allowed to create money is the Fed, right? It's the source of the dollar and it's the only institution that has the right to that printing machine. But the banking system works in a way that every bank in the country, or in the world for that matter, is allowed to create money to a certain degree depending on how much money people have deposited in said bank. So let's say we deposit $1,000 in a bank. Let's call it Bank A for simplicity. What do you think is going to happen with that money? There's no point in them just holding on to it. They wouldn't even be able to pay us that miserable 0.5%. So what they do is they lend your money to someone else who wants to buy, say, a car or a house, and they collect interest on that loan to them, which is a lot higher than that 0.5% that they're guaranteeing us. The average interest on a credit card is roughly around 20%. That's insanity. It's dozens of times higher than what the bank will pay us. Now keep in mind, the bank isn't going to actually tell you that it's lending your money out and to whom. That's why whenever you log into your bank account, you'll still see the amount you expect to find, and you can actually withdraw whenever you want. So then, this begs the question, if our money is still in the bank, where did the bank get the money to lend to someone else? This is what's known as fractional reserve banking, and what this does is allow banks to keep just 10% of the deposits they receive while they can lend out the rest. So this means for every $1,000 we deposit, the bank will create an extra $900 and lend it to someone else, which will bring the total amount to $1,900. So this means the bank created $900 out of thin air. That's pretty crazy if you think about it, but it's really not that complicated since it's just digits being entered into the computer. Alright, moving on. The next thing on this list that banks don't want us to know is that you can make money by borrowing money from banks and investing it somewhere else. And I'll explain to you what I mean by that. Mark Zuckerberg, in 2012, he financed his house in Palo Alto that was right near the Facebook headquarters, and he did it with a 30-year mortgage. And at the time, Mark was 28 years old and was the 40th wealthiest person around, amassing roughly $15.6 billion. So again, this begs a very obvious question. Why would he get himself into debt when he has those billions of dollars and can easily pay it up front? I mean, if he wanted, he could buy multiple houses at that price. So why get the mortgage? The answer is really simple, actually. It's free money. It sounds crazy, I know, because who would give you free money when you have billions already? Unless it was for a charitable cause, why would someone give someone else money for free? Well, as it turns out, it all has to do with interest rates. Remember that measly 0.5% interest rate that the bankers are so generous with that really isn't even worth keeping your money with them for? Well, in this scenario, it's totally the other way around. So the inflation rate in the US is anywhere between 2.5% to 3%. So any money you borrow below the inflation rate is considered free money. So Zuckerberg's mortgage rate was just a little over 1%. I think it was 1.05%. So if you do the math, the bank is actually the loser in this scenario since the mortgage rate is lower than the rate of inflation. I mean, you don't have to be a genius to do the math. If we borrow $1 million at the rate of 1.05%, keeping in mind before the pandemic, the average rate of return on savings accounts was 2.4. Now it's less than 1%, but we'll stick with the 2.4 just to keep with the Zuckerberg example. So this means if we deposit that $1 million in another bank, we're going to end up with $24,000 at the end of the year while having to pay $10,500 every month. Now imagine you do this with $100 million or even $1 billion. How would that benefit you? So when you can borrow money for free, it makes no sense to tie up your own money when you can use that money for something more profitable. Now obviously, when we're talking about smaller amounts of money, it might not make sense because the difference of course isn't that big. But when we're talking about large sums, playing with a half or 1 or 2% could potentially mean tens of thousands, if not hundreds of thousands of dollars. The next point on this list is the richer you are, the lower the rate you're going to get. Now you have to remember that banks aren't nonprofit organizations. A bank, just like any other business, has the main goal of maximizing its profits. They have shareholders like any other company to whom they're accountable. So if that business model isn't profitable, they won't survive. And this is why banks are much more comfortable lending money to a rich person rather than someone who's struggling a little more in life. So if you're a billionaire, the bank will gladly deal with you because they aren't worried you could default on your loan. And even if something does happen and you can't make your monthly payments, you simply have the option of selling off a part of your company or assets to pay back the mortgage. This is why for a bank, lending money to you is pretty much risk-free. This is essentially how the banking system we know today has evolved over the past centuries. Banks back then would only work with noblemen and people of stature that have money and assets such as land that can regularly bring in an income. Now compare that to your everyday average employee who might get sick or have a sudden disability or be laid off. If they're barely making ends meet, loaning money to them is extremely risky. Now a lot of people criticize the banks for this, but I kind of can't blame them because think about it. Who would you feel more comfortable lending money to? A friend who barely makes ends meet and never really has much money? Or a friend who has a business and a regular monthly recurring revenue? Probably the one with the business, right? No matter how harsh this sounds, this is just the reality of how we are. So the bottom line here is, if you want to get lower mortgage rates and credit cards and just better terms in general, you have to be more financially sound first. Another reason why banks offer such low rates, by the way, is to help build a strong relationship with those rich people, in the hopes that if they need a bigger loan for business or a business expansion or something like that down the line, they think of that bank and come back to them. So it's really a win-win situation if you think about it. Another interesting point that I want to mention here or to touch on is how technologies like blockchain or cryptocurrencies are playing a huge role in changing the banking system and help democratize it more. And honestly, I think they will do it to a fairly big extent. Now again, looking back to a few centuries ago and how the system was only catering to the super wealthy, as opposed to now where pretty much everyone has access to financial services. Just 100 years ago, that wasn't the case. Okay, last but not least, because I don't want to take up too much more of your time here, the last thing on this list here is that credit cards are the bank's best friends, not yours. So just this year, 70% of Americans with credit card debt admit they can't pay it off this year. Think about the implications of this for a second. Your credit card debt isn't the same as your mortgage. It isn't something like 3.5% or 4.5%. It's closer to 20%. So if you can't pay your credit card debt off now, what makes you think you'll be able to do that in a few months when the debt is even bigger? So in essence, 70% of Americans are on the cusp of falling into this debt trap. Another interesting fact was that half of those surveyed, just about 56%, say they've been in credit card debt for at least a year. Unfortunately, most of them will carry it with them for over the next years to come. About 20% of them believe that they'll be able to pay off their debt in no less than 3 years, and 8% have no idea when they're going to be able to pay it off. This is how banks make their fortunes, banking on the fact that most people spend without even thinking how they're going to pay it back. They're just used to a certain standard of living, and they're ready to do whatever they can to keep it up, even if they can't afford it. And this is why banks keep calling you and bombarding you with credit card ads trying to sell you a brand new credit card every month. Now, I don't want you to misunderstand what I'm saying here. You can use credit cards, but you just need to use them responsibly. This is how you build up your credit score. But if you aren't financially literate and act responsibly, then don't even bother setting yourself up to get sucked into that debt trap. So I hope you guys enjoyed this video, and if you did, please hit that like button and share this video with anyone you want to make more aware of these things. Also, if you haven't done it yet, please make sure to subscribe to the channel and hit that notification bell so you know when I come out with a new video. Until then, I hope you guys stay safe, and I'll see you soon. Bye bye.